Yeah, good afternoon, everyone. The Master Knowledge Series Triple E, a series of webinars to enable and enhance the knowledge of our members and to help them excel, launched at the National PCS Conference in June 23. A total of 5 such webinars have already been conducted with huge success. Today, I welcome you at the 6th webinar of the Master Knowledge Series Triple E. Triple E denotes enable, evaluate, and excel. Triple E1 series started in 2017 and Triple E2 started in 2019 under the leadership of our past president Ranjit Pandey ji. Now we all are thankful to our president Manish Gupta ji, VP Narasimhan ji, and CLGC committee chairman Shukla ji, my colleague in the council, for this Triple E series. As you all are aware, the aim of these webinars is to provide comprehensive understanding of corporate law to develop the skills of our members to effectively deal with the challenges encountered in rendering professional services. The focus of today's webinar is on the topic ESG, emerging role of we company secretaries. ESG has come to play a crucial role in delivering sustainable business advantages to the investors while controlling the impact on environment and creating sustainable societies. The recent drift from financial to non-financial reporting, the introduction of BRSR framework for reporting all point towards the increasing role of company secretary in ensuring that the company operates in a responsible and sustainable manner. To deliberate on this topic, I hereby welcome our own speaker, our own member, CS Priyadarshini Mahapatra, Company Secretary and Compliance Officer, Syngene International Limited, the research arm of Biocon Limited. She is a fellow member of ICSI, an associate member of ICMAI, and an associate member of the ICSA London. She has a rich experience of 20 years in corporate and securities law. She has also served various organizations like ACC, Mahindra & Mahindra, Reliance Power, and Tata Steel. She has co-authored various famous publications on corporate law. Madam, we feel immense pleasure to welcome you, to have you with us in this valuable webinar and looking forward for your words on this topic. Before beginning our discussions, I would take this moment to share that 23rd edition of our ICSI National Awards for Excellence in Corporate Governance have been announced. And I would urge all of you to send applications for different categories. Not only is it a perfect opportunity to gain accolades, but to measure our own performance on the governance front, because we are the architect of governance. My best wishes. With this, we begin our deliberation on ESG. Over to you, Madam CS Priyadarshini Mahapatra. Please, Madam.
Thank you, Sandeep ji. I'll share my screen first and then I'll start.
Yes, Madam.
Is my screen visible? Right. Thank you again, Sandeep ji. It is my pleasure and my privilege to address my fellow colleagues in the profession. I feel these webinars are a great initiative by the Institute in providing a forum for us to share our knowledge on the contemporary topics. ESG definitely is a burning topic. Of late, we have seen that ESG sits firmly on the C-suite agenda. ESG challenges each member of the C-suite, whether it is a CFO, the Chief Operating Officer, the CIO, the Chief Compliance Officer. It challenges them in their functional areas of expertise and also in the strategic growth and their resilience priority. So sustainable business practices and transparent ESG reporting, these are now increasingly taking the center stage. While sustainability reporting is not mandatory in many countries, but we have seen a lot of growing large companies, successful companies, which are recognizing that ESG reporting can prove to be a very important differentiator for them amongst their peers, amongst the competitors. In addition, more and more lenders, the investors, they are also imposing sustainability related requirements on companies and are seeking financial information, non-financial information from all the companies who are actually seeking finance from the market, from the investors. So it is the stakeholders mostly now that we see, whether it is the customer, the employees, the shareholders, the lenders, the rating agencies, the proxy firms, the regulators. Everyone is now demanding the companies to consider how their business is impacting the world, what is their contribution to the society, and how are they actually conducting themselves. So I'll just move to the presentation. I've divided it into 4 parts, the introduction to the ESG. So I'll be taking you through each and every aspect of what is the ESG with respect to a corporate. How has the ESG reporting framework developed around the world in India? What is the requirements under the BRSR core, the disclosures, the assurances that SEBI has now imposed on some listed entities, which will probably be rolled out to the other listed entities as well in the near future? And last but not the least, what is the role of the company secretary? What is the role of the board? What is the role of the management? How do we together in our respective roles ensure that the company promotes sustainable management, promotes compliances, promotes the strategies and develops these strategies and moves to these strategies to drive the ESG performance within the companies? So moving on to the introduction to ESG. As we all know that ESG stands for an acronym, which is environmental, social, and governance. It is a framework that helps the stakeholders to understand how the organization manages its own risks and the opportunities around the sustainability issues. Though the term ESG, it had first made its mainstream appearance in 2004 UN report. It was, however, till the late 2010s or moving into the 2020s that ESG has now emerged as a much proactive movement rather than a reactive action. So though ESG is often used in the context of investing, but the stakeholders here involved they include not just the investing community, they also include the customers, the suppliers, the employees, all of whom are now increasingly interested in knowing how sustainable an organization's operations can be. So let's move to see the environmental, social, and the governance aspects of a corporate. So coming on to the environmental area, it is our commitment to the future generations. It is how the company has conducted itself that it is now impacting the environment. What are the risk management strategies, the policies that the company has started to imbibe to address the risks with respect to the environment? So these can be direct or indirect impact on environment, say for example, climate change, greenhouse gas emissions, natural resource depletion, waste management, deforestation, hazardous materials, pollution that is being caused by the industries, biodiversity. It can also include use of renewable power, renewable energy. So whatever impacts or whatever effects or whatever is gaining or reducing the impact of the company's operations on the environment is what is measured in the environmental factors. So it is how the conduct and the operations of the business impacts the environment is actually captured in the environmental factors. Moving on to the social factors, it is what is the value that is realized and how the value is shared within the society is what is considered under the social factors. So social is about human rights, it is about equity, it is about the relationship with the people, with the society, the impact that the policies of the company have on individuals, on groups, on the society as a whole. In a business context, it examines all the people interactions against the principles, against the policies of ethics, justice, and care for the well-being, whether it is of the society, whether it is of the employees. So various factors under social to be captured for a corporate would include would be in the form of the working conditions, which includes slavery, forced labor, child labor, the impact on the local communities, say, for example, provision of rehabilitation in case of any displacements that has been done because of a new unit of a company coming up at some place, waste emissions into the local community. So these are factors which actually affect the society at large. Then the health and safety, whether the company has an EHSS policy, whether it has an occupational health center, whether it is organizing annual health checkups for its employees, safety trainings whether are being imparted to the employees, or for that matter to the contractors, the workmen who are coming into the facility. What is the health insurance coverage that is being administered to the employees, to the workmen? So these are some of the factors which impact the social part of it. The others would include employee diversity. Now, diversity is not something which would only look into the gender diversity part. It could be diversity not only in terms of gender, but also in the terms of ethnicity, in terms of age, in terms of persons with different abilities. So, special abilities. So these are things that have to be the soft aspect of which the companies need to consider while strategizing their future, their businesses. The other criteria could be product mis-selling, product returns coming back from the market, data protection, at least in the light of the data privacy laws, the IPRs, maintaining of personal data. There are a lot of service industries where personal data of whether it is clients, whether it is of employees, which is of utmost importance. So, and a lot of companies actually now with multinationals coming in and working in India, Indian companies servicing a lot of other countries, the companies in other countries, it is very important that we also follow their laws, because that definitely comes into play where it comes to data protection. So moving on to the governance part of it now. Governance is how we conduct ourselves. How is it that the outside world sees us? How do we lead ourselves? How do we manage ourselves? And how does it align with the stakeholder expectations, with the shareholders' rights, and with our internal controls? So it includes the rules, the policies, the systems in the organization, all that has been implemented to drive the corporate behavior. So the factors that need to be seen here are executive pay, bribery, corruption, which includes whether the company has a ABAC policy, an anti-corruption, anti-bribery policy. Does it have an ethics officer, chief ethics officer is in place? Whether there are proper grievance redressal mechanisms in place, coming to refraining from political lobbying, donations, public policy advocacy, board diversity and structure, data breaches. These are all covered under the governance part of the ESG metrics. So as we see that it is not just the financial parameters, it's not the top line and the bottom line only that is driving businesses now. It is even the non-financial drivers in the terms of our impact to the environment, our giving back to the society, our conducting ourselves is what also drives our business these days. Going on to the reporting frameworks on how the reporting framework has emerged in the years that have passed by. The world has seen a lot of issues recently, and definitely in the past also, a lot of complex problems, issues in terms of climate change, global warming, human rights violation, data privacy, cybersecurity, ransomware attacks. These have all gained a huge importance in the minds of not only the companies, but of the investors as well. There are a lot of historical movements that have happened focused on health, safety issues, labor issues, pollution control issues, corporate philanthropy, which has all helped ESG to evolve. The best example, the most recent example is the pandemic. The pandemic actually highlighted the social and the governance elements within the ESG. As the businesses were seeking to save jobs, protect the jobs of employees, to support the efforts to control the virus, to do everything that is right. And the businesses actually pulled up themselves. So COVID-19 has highlighted the importance of resilience to the extreme change and our ability to undertake that radical transformation. So seeing the change that has evolved, it can easily be said now that ESG isn't anymore a hygiene factor. It is no longer a choice. It has now become an imperative. It is something which has been imposed by the law and has been definitely understood by the government, and it has to be imposed to the corporate world. Otherwise, the world may probably not be a good place to be in the next 30, 40 years to come. So the global environmental, the social challenges, all facing the world has actually made the government and the corporates come together. So a lot of standards have come into place. Many organizations have come up with these standards, which are now introduced and are being followed the world over. So when it comes to these standards, they operate in a very different manner across the industry. There are different standards which have different approaches. Say, for example, there is some countries, they would like to follow a complete hard law approach where there is codified, legislated requirements to be followed by companies. Whereas some countries have followed the soft law approach where there is a voluntary disclosure and not a codified or a legislated requirement. There are approaches in these standards which talk about compliance, which talk about compliance or explanation, or which can talk about compliance and explanation. These standards, these laws have now started to align worldwide. And some jurisdictions where we have seen that, these laws, these standards, these reportings are either merged with the annual report or given as a separate report with the annual report. So till the time that BRSR was not made mandatory, we were seeing a lot of companies were actually coming out with sustainability report, getting sustainability audit done, separately bringing out their CSR reports, all something over and above the statutory requirement in line with the various standards, the GRI standards, the SABS, the different standards that have been imposed to disclose what they are doing, what is their impact towards the society, to the environment, and to their governance level. So this was something that I'd found on the internet. I did not want to disturb it because I thought this was a very good slide. I've given the source below. These are the three main sustainability reporting frameworks, which you can see. The first one being the Global Reporting Initiatives, the GRI standards, as we say. So these are very common standards which are adopted by most of the companies, large companies, where it helps the business, the government, and the organizations to understand and communicate their impact of the business on the critical sustainability issues. So GRI for over 25 years has developed these standards and is globally recognized also to communicate and disclose the information placing the accountability of the impact on the environment, on the economy, on the people. So the GRI standards are a modular system, and it comprises of mainly the GRI universal standards, which is applicable across, GRI sector standards applicable to separate industries as maybe used for a particular type of sector, and topic standards, GRI topic standards. So it is 3-level standards that has been prescribed by GRI. And these standards, these requirements of the GRI, these are mostly requirement based or recommendatory based. So requirement basis, whatever is required under the law has to be disclosed, has to be complied and to be disclosed. Recommendations would include something which is voluntary course of action, something which is encouraged to be done and is a good to have factor. Next comes the integrated reporting framework, which we have seen across the last 5-7 years, that most of the companies, most of the large companies are publishing their integrated reporting. So it creates the value, it actually discloses the creation of value over a short term, medium term, and a long term. And not just the financial value, but also the non-financial value based on 6 types of capitals which is employed by the business. So these capitals are the financial, social, natural, intellectual, human, and the manufactured capital. So moving on to the next standards that is very widely used is the Sustainable Accounting Standards Board. So it helps the businesses to identify, manage, and report the sustainable topics that matter the most to the investors. Apart from these standards of reporting, there are others which are reported by the companies, say, for example, the CDP, the Carbon Disclosure Project. So this is a voluntary framework that is very popular amongst the companies, and it is used by the companies to provide the environmental information to the stakeholders. So these CDP, it provides mostly 3 questionnaires for the companies, and which is relating to climate change, forests, and water security. Moving on to the next one is the SDG, the Sustainable Developmental Goals. So Sustainable Development Goals is prescribed by the United Nations. So United Nations has come up with these 17 global goals to be accomplished by, intended to be accomplished by 2030. These global challenges, these actually address the global challenges like poverty, inequality, climate change, peace, justice. So you would recall that it also finds a mention in Schedule 7 of our Companies Act, which prescribes the items to be considered as a CSR, where any contribution promoting any SDG goal is also encouraged as a CSR activity. So this also finds mention in our mandatory requirements and CSR regulations. Next coming is the Task Force on Climate-Related Financial Disclosures. These are guidance frameworks which assist companies in disclosing the climate-related financial risks to the investors, the lenders, and the stakeholders. So all these years, companies, without any standard, without any other statutory requirement, were actually disclosing their ESG parameters through these standards, which had prescribed the manner in which the disclosures were to be made. These disclosures, the companies have recognized, have actually brought to them quite a large number of benefits. So with the pressure coming in from the investors, from the regulations, the issuers have complied with certain disclosures. They have, because when you make a disclosure, you actually go see what are the opportunities, what are the risks, what are the challenges, strategize what is your mitigation strategy. So you actually come to know a lot about your organization. You come to know what is it that is helping you drive to a performance that you ought to reach in a few years' time. So you set that entire pathway of ESG for yourselves, which also is recognized in the industry. So what people have realized is these disclosures have actually helped them to get financial benefits. Financial benefits meaning more diverse investor base. Nowadays, when you enter into any analyst call with any of the analysts or the investors, you are questioned about the ESG aspect as well. It is not merely the financial aspects that they are concerned with. They also want to understand what is the business contributing in terms of ESG to the society, to the environment, to the value chain. So what is it that we are actually doing and is helping to reach to that level? What is our goals? What are the what is the strategy that we've developed to reach to the goals? So definitely it comes up with a financial benefit of investors wanting to invest in such companies which have a strong foundation, not only in terms of finance, but also in the terms of ESG. It may also result in a lower cost of capital, because with all the ESG requirements met, there is a possibility of laws. In fact, there are discussions that in case certain ratings are not achieved, then the companies have to be provided a higher rate of interest. If it is achievable, if the rating is good, then there is a low cost of capital which is involved. So these are things that we are moving into. This is the world that we are moving into gradually. And there are varied financing options available in the market where it comes to ESG compliant companies. Moving on to the operational benefits. Now, when you decide the strategy to probably set up a new unit, you would probably look into where will the power come from? Is there a possibility of having a renewable power there? There will be a low cost, there will be a good contribution to the environmental factor. So we started thinking in those terms, and these have actually helped in improving the long-term risk management. So these risks which are actually addressed when we move into the regime of a ESG reporting. Then there is a better understanding of our own organization, as I said, because you want to understand what are your opportunities, what are you good at, you want to improve those. What are the challenges? What are the risks that you see? You want to mitigate those. And in that process, you want to understand how do you want to do it? Where are the lapses? Where are the gaps? That is when you understand your business better. Imagine a situation when you had not got to publish the BRSR. Which company would actually go and see what is the level of water that you take from the ground level? What is it coming from the river level? What is it coming from the other levels? I mean, we would not go and differentiate between that. But now when we are having to report it, we are actually seeing, we are measuring, and then we are reporting. And we are being aware of what is the change that has to be carried out in this case. Further, this would lead to much more informed decision making and definitely a strategic planning. So moving on to advanced communication and reputation. So when we are disclosing, we are so moto proactively disclosing that these are the requirements, these are the facts that we have, this is where we want to be, this is our pathway to it. So you are giving a clear communication to the market, to the investors, which gives them a confidence of where the company is moving to, what is it that the company wants to achieve, and it gives it definitely boosts their confidence to remain invested in the business, and that draws a reputation. So moving on to the next part is the business opportunities. So definitely anyone would want to do business with a company which is low on pollution. If I'm actually polluting the environment like anything, I'll think twice before having that company in my value chain. So these are definitely leading us to have good business opportunities. And last but not the least, there are other potential benefits also in terms of tax exemptions, in terms of incentives. So we are looking forward to a regime where government would also come up saying that, you meet these standards, you will be eligible for this. There are tax incentives for buying EV vehicles. Similarly, there'll be some way or the other where government would also want to incentivize and encourage companies to move into this regime. Now moving forward, what is our mandatory sustainability reporting that we have followed in India, the journey that we have come across in India. So all these years, we've seen companies reporting their sustainability report based on GRI standards, etc. Now, SEBI, in 2012, it mandated the top 100 companies by their market capitalization to report as per the Business Responsibility Report Framework, which has been developed based on the National Voluntary Guidelines. Just a minute. Yeah, which has been developed on the basis of the National Voluntary Guidelines. This was then subsequently moved on and extended to the top 500 companies based on their listed companies based on their market capitalization. In the meantime, MCA released the national guidelines on the responsible business conduct, the NGRBC is what we say, in December 2018, and which was actually prepared on the basis of the 9 NGRBC business principles. So we'll be discussing the principles in details. The extract of the NGRBC actually forms the basis of developing the BRSR, the Business Responsibility and Sustainability Report, as we say. So from 2019 onwards, SEBI mandated that the top 1,000 companies based on their market, top 1,000 listed companies based on their market capitalization must disclose their reporting as per the BRSR framework from 2020 to 23. There was 1 year in which, that is 21-22, when this was actually introduced by SEBI, that it was made voluntary. So a lot of companies had actually gone and published the BRSR voluntarily, even if it was the first year of non-mandatory requirement. So moving on to the 9 principles, the 9 NGRBC principles. So on the basis of which the entire BRSR report has been framed. These principles, they are based on ethics, transparency, accountability, on providing goods and services in a safe, sustainable manner, in promoting the well-being of employees, ensuring that the interest of the stakeholders is taken care of, promoting human rights, making efforts to protect the environment, how the companies are actually influencing public and regulatory policies, what are the steps taken by the companies to engage with various regulators, the promotion of growth and inclusive growth and equitable development, gender diversity, and engage with the value chain, with the consumers, and ensure that you conduct yourself in a manner which is responsible when you do business with others. So these NGRBC principles and the BRSR report, these have actually gone beyond the format of a financial reporting and have encouraged companies to report on environmental, on social, on their governance aspects as well. So the companies are required to find out what is it that they're doing good, what are the opportunities that they see that can be improved, what is it that are the risks for the companies, and what are the mitigation factors, what are the mitigation measures that they are taking to reduce the risks, and what is it that the companies are doing to ensure that the company is well governed. So the BRSR is actually divided into 3 parts. So the first part being the general information about the company. This is a mandatory disclosure. Then moving on to the management process and disclosure. So it is what the management has to disclose and say that these are the processes that we have adopted to ensure that these 9 principles are met. And then moving on to the principle-wise performance of the company. So we'll move on to it in the next slide. So staying here, the general disclosure and the management process disclosures, these are the mandatory requirements which have to be ensured by any company which is following the BRSR requirements. So when it comes to the general disclosure, it is about the general information on the company, on which stock exchanges it is listed, what is the number of employees that it has employed, or what are the markets that it is serving, what is the CSR expenses that the company has incurred, what are the types of customers that are available, that are being served by the company, what is the grievance redressal mechanism that is available for different stakeholders, the communities, investors, shareholders, employees, customers, value chain partners. So what are we doing to at least understand what is their grievance and whether we have any grievance redressal policy and a system in place to address their grievances. Then the details of the employees, the permanent employees, non-permanent employees, workers, male, female, differently abled, the attrition rate that we see amongst the employees. And the most important part, as I keep on reiterating, is to find out the risks and the opportunities with relation to the environment and the social matters. So these form the general information, general disclosure about the company. Then is the management and processes. So it is a report by the management of what are the processes, the policies that the company has adopted to ensure that the 9 MGRBC principles are being complied with. So whether the company has policies for each of the principles, whether the policies are translating into processes, procedures, whether there are proper SOPs in place that are ensuring that the policies are actually being complied with, whether these policies extend to the value chain, what are the different national, international codes, certification standards that have been adopted by the companies, then what is the specific commitment or what is the goals that has been set by the company. So this becomes very important because you are going public and disclosing what are the goals that you have set for yourself, and against each goal, what is the achievement that you have reached to at each year to actually go and meet it. So it is a very bold step for a company to disclose that this is the ESG goal that we are setting for ourselves, and that we want to see ourselves in that position in this many number of years, and each year report what is the performance of the company against such goals, what is the achievements of the company against such goals, and in case the goals or the targets or the performance is not proper, then the reasons have to be cited as to why we were not able to reach to that goal or the target that we have set for ourselves. So moving on to next, it is the company's performance against above policies by the board and the committee. A statement by the director who is responsible for ESG, highlighting the challenges, the targets, and the achievements again, and the details of the assessment or evaluation, if any, which has been carried out on the workings of the policies, and this assessment, whether it is done by an external agency. So this is the expectation that is being set. Definitely it comes with a cost as well, but this is an expectation that you cannot just say that you are doing this. Are you getting it validated or not? It's something also that the SEBI wants to push through with the companies to say that at least it should come out clear that this is only what we are saying. Nobody else has validated it. So that disclosure also has to be made in the BRSR report. Moving forward, the next part of the report is the performance of the company against each of the principles. So this performance is actually divided into two parts. It is the essential indicators, which is a mandatory requirement, which has to be minimum standards, which have to be disclosed by the company. And the second one is the leadership indicators, which is voluntary. So companies may or may not provide this information, but these are good to have provisions, which the companies must strive to at least meet and address. So coming to the essential indicators, these are something which are actually done by the company and requires disclosure in the report. So it is the training and awareness amongst employees. What are the trainings that have been carried out with respect to each of these principles? How many trainings have been carried out? What is the percentage of attendance in those trainings? So if it is carried out for the employees, for the board, for the KMP, how many of such people have actually attended the trainings? Then comes the details of the fines, penalties on the company's directors, on the KMPs, and the CAPAs against it, the corrective actions that the company has taken against it. what is the capex and the R&D expenses that companies have incurred on the environmental and social factors? What is the percentage of sustainable sourcing? And what percentage of your materials have been sustainably sourced? So sustainable sourcing meaning how much materials have you actually sourced from small suppliers close to your vicinity, to your facility? How many of those are MSMEs? So it is mostly promoting small companies. That is definitely the intention, that as a big corporate, as one of the top listed companies, you must also ensure that you provide the right support to the environment, to the people around you. Then is recycling of plastics, waste management, hazardous waste. Then measures of well-being of employees. Well-being measures would be like providing them the health insurance, the NPS that we provide to employees. So there are different details of the retirals that is there, provision of creche facilities, even tracking to what extent do people actually come back after a maternity leave, whether it is after a child, whether it is a man or a woman. So how many people do come back? How many people are retained? What are the strategies that the company has for people who retire? So after retirement strategies, is there anything that the company is offering to the employees? Next comes the health and safety management, the safety parameters, the incidents, safety incidents that have happened in the last 2 years have to be reported. The external assessment or the internal assessment on the health and safety practices. So safety is a very important aspect here. Safety of the employees who are working, of the contractors who are working within your facility. So there is a liability on the company for so many people who are working inside the premises. So it is not just disclosing what you are doing, but also getting an external confirmation that what you are doing is actually the right thing to do. Next comes the details on the energy, water consumption, air emissions, waste management. So there are a lot of such things, a lot of such facts that have to be provided in the BRSR report under the essential category, in essential indicators. I have not cited everything, but these are most of it. Now coming on to the leadership indicators, the good to have provisions, as we say. So how many of these training awareness programs have the companies imparted for the value chain providers? What are the details of the assessment that has been seen that the value chain providers are actually meeting these policies? So are we going that forth to go and assess the value chain providers of complying with what they are claiming and agreeing to adhere to as per our code of conduct? What are the awareness programs that are being extended to the value chain for health, for safety, for human rights? And what are the corrective actions? So even if we have conducted an assessment on the value chain, if there are any action points that have gone to them, are they coming back and telling what are the corrective actions that they have taken on it? Because that becomes very important, that you conduct the assessment, but what after that? What are they doing after that? So that also has to be reported as a leadership indicator. Then the process to manage conflict of interest among the board members. Does the company have a policy to manage conflict of interest on the board? So generally, conflict of interest is something that we cover under the related party transactions. That only in case of a transaction there could be a conflict of interest and some person gives his disclosure, but there could be something greater than that. That there could be something more than that. There could be disagreement within the board. Then what? What is the policy that the company has around it? Have we framed a policy? Have we framed the process of who is to intervene? How is it to be done? So these are something which are eye openers, which are something good, which has to be done to prevent the happening of an event which may not go well with the investors, with the company's reputation, and has to be looked at with immediate attention. Then there is life cycle perspective assessment on the products, on the services that are being offered, what are the concerns, the risks that are identified, and what is being done to mitigate those risks. Then comes the details of the product packaging that is reclaimed, process of consultation with stakeholders and the board. So does the board consult the stakeholders? On what occasions does it consult the stakeholders? If it has some feedback from the stakeholders, has the board actually implemented any? So these are something that definitely, is the expectation. And I'm not very sure how many companies are mature enough to have the board interact with the stakeholders, take their feedback, and then include it within our companies and make a disclosure of it. Then comes the breakup of the energy consumed, the water discharge, direct, indirect impact on the entity, on the biodiversity. So these are again the leadership indicators. Now coming to the BRSR core. So on July 12th, 2023, based on the ESG advisory committee, SEBI brought out another circular, and it brought out certain other KPIs under the BRSR core and said that these are some things that you have to additionally disclose in addition to what you're already giving in the BRSR report. So it came out with the KPIs for the BRSR core. It revised the BRSR report to include these KPIs, and which would become applicable from 23-24. The disclosure and the assurance requirements on the BRSR core for the listed companies and the companies in its value chain. So as we see, BRSR core is a subset of the BRSR, and these KPIs have been fixed under the 9 ESG attributes which have been enlisted here with. So it is the change in the greenhouse gas footprint, the water footprint, environmental footprint, waste management, employee well-being and safety, diversity in business, inclusive development, engaging with customers and business, openness of the business. So wherever there's an overlap with the BRSR, that has been separately highlighted in the BRSR core. So under these 9 attributes, there are approximately around 50 KPIs, the performance parameters, that has been identified by SEBI to be reported from the next financial year. I mean, this financial year rather. So the BRSR core here, the company is supposed to make not only disclosures on the BRSR core when it comes to itself, but also extend it to its value chain. There is a glide path in which it will move on to the value chain, but there are things to be considered here. The value chain here would be upstream and downstream value chain with 75% of the values of the purchase and the sales. I believe that there could be a pushback for it, or may not be also, because they have come for the value chain. They say it has to be a limited assurance and process with a comply or explain mechanism. Most probably companies would want to explain. Say, for example, I'll give you the example of my company. My company is into research and development activities, mostly in pharma sector. My value chain, whether it is, where it comes to the sourcing, there are a lot of things that we source through the chemicals that we source through China. How many Chinese companies would actually want to share information, that level of information with us? There would be some companies which are MSMEs, small chemical suppliers, is where we get the bulk of our supplies from. That is an unorganized sector. Putting on the pressure of having an assurance, providing information, the kind of information that is asked is something that a company has to actually put a manpower to measure. So asking for that information is definitely, if not a major cost impact on the listed entity, would definitely be an impact on the value chain, the entity in the value chain. Moreover, my business, the business that Syngene is in, we export 97% of our contracts. I mean, it's all the clients, most of the clients are outside India, UK based, US based, who would actually want to share that kind of information for publication in India? So these are probably we may go for it because I'm not sure whether we'll get that kind of information from our value chain and whether we'll be able to explain it to them, whether we will be able to publish those information in India. So we may probably have to go for an explain mechanism, which definitely does not solve the purpose. So I'm not very sure how other companies dealing with it, but this could result in a pushback. Moreover, I'll come to this slide later on the applicability, since we are discussing the assurance of these disclosures. There is also a lack of clarity in the process of having this assurance of the value chain. Who is going to do that assurance? Who is responsible for it? Is it the supplier in the value chain who is to conduct it? Say, for example, a supplier is a supplier to around 4-5 companies in the top 250 companies in India, listed companies in India. So is it the responsible of the supplier to conduct its assessment and then pass on that information? Because in that case, that is the viable thing to be done, because in that case, it will at only in one instance provide the information, send it to the respective users. On the contrary, but it will then put a financial impact on the supplier to have it done and then share it with the listed entities. On the other hand, if it is carried out by the separate listed entities all by themselves, so each listed entity will have a different assurance provider, will ask for separate samples from the supply chain, the supplier in the process. And in that process, we may end up with 5 different reports, which may not be matching with each other. So this is something which SEBI has to provide clarity on as to what is expected, how is this assurance for the value chain to be done, and how is it that we can maintain a parity and get that executed. Moreover, the listed entities should also ensure that there is complete independence of the valuer from any other audits or assurances that we are doing. So suppose you've taken the help of a Deloitte or a PwC to help you draft your BRSR report, understand what are the ESG requirements. You cannot ask them to do an assurance. It has to be a separate party to be doing an assurance. So going back to the applicability. So the disclosures as per the amended BRSR format, that is applicable to the top 1,000 listed entities as per the market cap from the financial year 23-24. Reasonable assurance. Now, I put a little emphasis on the term reasonable here. Reasonable assurance, because the other assurance that we'll be referring to under the value chain would be limited assurance. So here they are expecting reasonable assurance on the BRSR core by the listed entities. So for the top listed entities based on their market cap, it has to be from financial year 23-24. So it's actually not giving them any time. They just have to start and be on the job and just go and disclose and get themselves assessed. For the top 250 listed entities, as per the market cap, it is 24-25. For the top 500, it is 25-26. And the top 1,000 companies, it is 26-27. So by 26-27, we actually expect all the companies, most of the companies in the listed category to be reporting on the BRSR core on these KPIs and to be assessing themselves on those aspects as well. Now coming to moving this to the value chain as well. So the companies are also required to disclose the BRSR core to the extent attributable to the business for the top 250 companies on a comply or explain basis to move it to the to disclose information on the BRSR core for their value chain partners as well. So for the top 250 companies, it will get it'll come into force from 24-25. The limited assurance in respect of these top 250 companies has to be for the value chain BRSR core disclosures will have to be provided from the financial year 25-26. So there's a breather given there where companies, because you really have to convince a lot of people, you really have to see how many people you have to access. Again, coming back to the position, so where you want to address and where you want actually companies to do more business with the vulnerable part of the value chain, the less organized sector, the MSME sector. At the same time, you're expecting them to provide the kind of information which they will probably shy away and they would not want to provide. So it'll become a very difficult task for companies to keep them in their value chain. So definitely it is that, 75% would be the major chunk. They may come in the 25%, but we are not looking to actually promote this kind of a culture of providing the right the right mechanisms or helping these small companies to actually come up. It is actually dissuading them to provide this information. So even if you go to these people and say that you provide me information, no one would want to give this information. So then comes the difference. So now, so I go back to the emphasis that I was drawing to of reasonable assurance and the limited assurance, the difference between that. So having covered this, so reasonable assurance is it sets a high assurance engagement where the assurance provider is concerned, and limited assurance, as the name suggests, it gives a moderate assurance engagement. So these are mostly the high assurance engagement. The reasonable assurance is provided on unrestricted, deep dive, extensive sampling and evidence gathering exercise. Whereas for a limited assurance, it is less extensive. The evidence gathering is also to just ensure that it is worthy of being trusted. So we do not actually go and delve into what is the don't make a deep dive into what is the actual details. We take some of the samples and then perceive that this would be what it. There's nothing wrong with what has been provided. The time frame in case of a reasonable assurance is fairly extensive, but the time frame for a limited assurance would be a shorter span of time. So I've quoted two examples of how the reasonable assurance and the limited assurance reads, so that you can understand what is it that the assurance provider actually, to the extent of the audit that the assurance provider will be doing. So when it comes to reasonable assurance, it is, we hereby state that the information disclosed by the company is true and fair. So it is a very confirmative statement. It is a very confident statement that we have seen everything and we state that this is what it is. Next is, we hereby state that the company is in compliance with the applicable laws. So there is a confidence that you see that, yes, we have checked that the company is in compliance and this is what it states. Now coming to a limited assurance, how does that read? It reads, it starts with a negative connotation of nothing has come to our attention that causes us to believe that the disclosed information is misstated. Nothing has come to our attention that causes us to believe that the company is not in compliance with the applicable laws. So we haven't seen anything which is wrong, but we haven't seen everything, that means. So that is the main difference between reasonable and limited assurance. So when it is an assurance to be provided for the company, it is definitely meant to be a reasonable assurance. For the value chain providers, it is meant to be a limited assurance. Now, another major thing is the ESG rating providers that we see. So till about a year or so, just till the beginning of the year, we were seeing a lot of rating agencies who used to assign ESG scores. You would compare them, you would not find any, one company would have rated you on governance very high. The other company would not have rated you at a higher pedestal where it comes to governance. So there was no standard of reporting. It was whatever information they picked up from the websites, from what is publicly available, framed their requirements around it, and then produced their ESG scores. Now, recently, again in July 2023, SEBI has come up with these guidelines on for the ESG service providers, providing very clearly outlining the procedural requirements, the disclosure obligations, and the general guidelines that would be applicable to the ESG rating providers. So providers have to actually get themselves registered with the SEBI and then provide the information. So companies must engage with them, provide the information, and then get the assessment or the scores for the ESG ratings. Moving forward, now comes the role of the company secretaries, of the board. What are we expected to do? What is it? I mean, there's so many things that have come up in ESG. There's so many things that the company is required to do. What are we as professionals required to do to ensure that the company is actually moving on to a sustainable reporting framework? The main thing is we are privy to a lot of information. We sit in the boardrooms, we hear the discussions, we are aware of the strategies. At least we must see and find out whether the right questions are being asked, whether the answers to the questions are being framed in a manner that is addressing the needs of the society today, whether we are actually identifying all these risks within the strategies that we are framing. So it is very important for us to find out the answers to and ask the right questions on what is our relative ESG maturity. Are we matured enough as an organization? What is it? What are the gaps that are there? How is it that we meet those gaps? What are the ESG opportunities that we should prioritize on? And what are the risks that are critical that needs to be mitigated immediately? How do we strategize to respond to the climatic changes, to the other changes, to the waste management? So any gaps that we see that are coming up when we are finding our foot in the ESG framework, that is when we must ask the right question and see that it is answered in a manner to reach to the goal that we want to achieve. How do we engage and ensure the stakeholders buy-in for the ESG strategy? So we do a lot of ESG work. Are we communicating it to the investors? Are we engaging with them? Are we asking them what is it that they want us and they think that we should be doing? Because the investors, the analysts, the outside world, they also see what is happening with the other industries, with the other competitors, and they definitely will come up with some things that we may not be able to identify within our systems. What are the targets that we have set for ourselves? And publishing those targets. So that is a very crucial point of identifying what the targets would be and then actually coming up clear and telling the world that this is my target and this is what I want to do and want to achieve in such and such time frame. Then the most important, what are the lessons that we've learned from COVID-19 pandemic? Because this century, I mean, this is a very important part in the century. Earlier in the risk management framework of no company would you find a pandemic, but now it rests in the enterprise risk management of every company because that is a crucial risk that companies have understood that they have underplayed on. So what is it that the lessons that we've learned from the pandemic? What is it that has helped us learn that, we have to be a more sustainable business? Coming on to finance and reporting. So there are businesses which are into providing finance to companies. So how are these businesses, industries, what are the other businesses doing? How are they incorporating their ESG investments and approaches and risk management? What are investors looking for the businesses to report on across the ESG? What disclosures are mandatory? Are we complying with it? Are we actually disclosing it? How do we both confidently and efficiently manage ESG reporting with the requirements increasing? So with so many things coming up, are we at the right place, doing the right thing? Can we embed ESG into our debt financing and will it lower our cost of funding? So for companies who are looking for debt financing, ESG definitely plays a very important role because going forward, that will become one of the criteria for providing finances by the institutions or by the investors. Moving on to the operations, what is it that we have to ask and understand in those areas? Where do we stand and how do we optimize the ethical and sustainable footprint of our value chain? We do a lot of things within the company. We have our code of conduct. We ensure that the employees are undergoing trainings under the code of conduct, are reporting under the code of conduct. What are we doing for the value chain? We are extending, we tell them that this policy is also applicable to you. We are taking a sign off from them that, you are agreeing to abide by the code of conduct. Then what? Are we actually going and seeing whether they are doing it? So there comes the requirement of an assessment, that we also need to understand that the people whom we are engaging with are also on the right footing. Because one would not want to be engaged with a company which is involved in bribery, which is involved in any corruption. So if it is in the news for the wrong reasons, I would not want to be associated with that company. So it is very important for us to also understand that our value chain understands what it means for us to have the right ethical behavior. How can being ethical and environmental improve our resilience and profit margins? So ultimately, it actually plays into the financial aspects. I start a new company. I see that I get renewable power. I see that my waste management is done in a manner that tomorrow I do not have to undergo huge fines, huge penalties. So these are actually going on to adding to your profit margins. It is not something, today it may look as a cost, but tomorrow it will be something that if you have to pull it down, if you have to close a unit for the purpose of a non-compliance, that would be huge. That would be much more higher and would actually affect the profit margins. So what are we doing today that will not impact our, or not adversely impact our profit margins in future? How can digital interface help us to track, trace our products, enhance operational performance, predict ethical, sustainable risks to our businesses? So digital interface. Digital interface in everything we do would definitely improve the efficiency, the capabilities, but it also comes with a cost. There's again a fear of a cyber attack. How are we actually dealing with that? So to promote ethical, sustainable, easy driving of the company, we must also look into how we can address the cybersecurity aspect as well. How do we ensure that our third parties are compliant with existing and incoming regulation? How do we adapt our operations to meet our business and ESG priorities? So these are questions that we must ask sitting in the boardroom, that when the board strategizes, to make them aware, to advise them that these are also things that you have to see, because you will be reporting this in the annual report going forward. This is something that will drive your performance in the future. This is something that will bring down the cost of capital in future. So this awareness, as a company secretary sitting in the boardroom, it is the awareness that we have to create amongst the management, amongst the board of directors, and drive certain changes that becomes very important for us to guide the board in helping them understand the importance of ESG. So there are a few initiatives that companies have undertaken when it comes to ESG, to have a proper policy around ESG. So when recently we've seen ESG coming too much into the scene, and companies frightfully looking out for different policies, checking whether you have a human rights policy, you have this policy, that policy. So at least have an overarching policy and understand that each aspect of ESG is covered or being addressed to in some part of the organization or the other. That is very important. Forming an ESG committee of the board, you have to take the board into confidence. The board has to be responsible to drive home the importance of ESG. Some companies have had the third-party assurance of the BRSR report, because these are a lot of information that is going out for the company. What is the validation around it? So companies have also gone forward to get it assessed. Companies setting targets, disclosing them, streamlining their policies against their processes. So a lot of good initiatives, a lot of best practices are being followed in the industry, and definitely I'm sure that it is being driven by the company secretaries, assuming that you're sitting in the board, you're aware of the changes, you understand how it is evolving, you understand the gravity with which SEBI is pursuing this. So summing up, the company secretaries have a very crucial role to play to navigate the company and the thought process of the management and the board towards promoting a sustainable business. So as professionals, we need to gear up as the expectations of all the stakeholders on ESG will just keep on increasing. It won't go down. So thank you. Thanks a lot.
Thank you, ma'am. We'll be asking some questions on behalf of Sandeep, sir.
Yes, please.
Okay.
I'll just stop sharing. Yeah, please go ahead.
How to verify accuracy and reliability of emissions calculated and reported by us?
So yes, that is what I was saying, that most of the companies that, we are dependent on our functions, on our internal capabilities to find out what are we doing. So it is important that we have third-party assurance on that front, because that is why, in the BRSR, there is one column where it is asked whether the BRSR, whether we have taken an internal assurance or an external assurance of whatever information that we are providing in the report. Because till the time you provide an assurance, there is no validity of that information. Sandeep ji, you're on mute.
I am happy to share that over 12,000 company secretaries are hearing you, madam.
Okay.
12,000.
Sounds good.
and I feel more proud when our own member, our own company secretary are speaker on our portal.
Thank you. I just hope I'm doing proper justice to the topic.
And I hope you dealt with very well all the topics regarding practical role of company secretary, as well as the role of the board, the quality as well as the quantity, voluntary versus mandatory disclosures, several indicators, BRSR and BRSR code, regional assurance versus limited assurance, and whatnot. Everything you have finished in a very well capsule form to all our members, more than 12,000 members, madam. There are so many questions from the members, so I am asking you some questions because the time permits. So one question is there any format for performance report?
Which performance report?
So I am coming to next question. So the next question is, value chain assessment is mandatory. If yes, what will be the process to follow the same?
Yeah. So as I was saying, there is no clarity that SEBI has given on how the value chain, there is a gray area in that. And it will be difficult. I don't know, probably there'll be a pushback. I am struggling with my company, as I told you, that in our value chain, I have a lot of companies which are Chinese companies, which provide APIs, which provide us chemicals. I cannot expect them to provide that information. And it is not possible for even, I don't think they'll provide the information, first of all. And disclosing in a country outside India, why will somebody give this kind of an information, the kind of KPIs that the performance indicators that has been identified for the BRSR core? It will be very difficult for those people to provide. Similarly, for my other upstream, where it comes to my clients, a lot of them are small biotech companies in US, UK. We do research for them. Expecting them to provide this kind of information, I'm not very sure whether they will have that information, first of all, and whether they would be measuring it, and to what extent they would be comfortable in, again, publishing it in our annual reports in India. moreover, again, coming on to who is going to do the assessment, whether it is the value chain provider, the supplier who is to do the assessment, or is it for the company to do the assessment? If the supplier does the assessment, that is the most, that would actually be the best thing to do, because the supplier, suppose it is supplying the same information to say around 3-4 other companies in the top 250 list of companies, then it provides the same information through one assessment. The cost is also less, but it will definitely be a cost on the supplier, which is also not fair. Going on to whether if it is done by the listed companies, now each listed company will have a separate value chain, the service provider to be doing the assurance for these value chain agencies, and they will take separate samples. They will do audits at different intervals. They will probably have different reports for the same value chain provider. So the process definitely is not clear. SEBI has to come out with some clarity.
Yes, ma'am. Yeah, the next question from our one of the member: how social impact in context of ESG is different from CSR?
Social impact is not just CSR. It is not your impact on the society only through CSR. In my society, probably, I must be emitting some bad gases into the society. I must be probably ruining the water level within the society. So these are things that would have a dual impact on the environmental aspect as well as the social aspect. So in my community, how do I function? I'm staying it's like I've shifted to a new locality. I'm staying there. I have to stay well with my neighbors. It's not that I go and build nice parks for them and hang swings there. It is how I conduct myself in that neighborhood, which is also important. So it is over and above CSR.
So next question is, like CSR committee, is formation of ESG committee mandatory?
No, ESG committee formation is not mandatory, but definitely it is something which is high time for companies to accept and to form. So you form it with another committee. Most of the companies are having separate ESG committees. Companies are combining it with the CSR committee. We have combined it with our stakeholders committee, because our stakeholders committee just does not see share transfers. We just have 4 physical shareholders. So there is hardly anything to discuss when it comes to the shareholders, but there's a lot to discuss when it comes to stakeholders. So there's a full discussion on what is that which is discussed with the analysts, with the investors, with the credit rating agencies, with the ESG rating agencies. All that is taken to the stakeholder committee. And that is where we decided that we must also bring in the ESG committee with the stakeholders committee, because ESG also assumes our responsibility towards the stakeholders, our interactions with the stakeholders, the expectations of the stakeholders from the company in respect of financial as well as non-financial parameters. So we felt it gels well there, and we brought it with the stakeholders committee. So definitely it is not a requirement under the law, but it is something which is high time for companies to definitely form.
And what are the future prospect of practice for a practicing company secretary in the area of ESG?
Oh, there is a lot of prospect, I would say, when it comes to practicing company secretaries. We generally choose our areas in the terms of taxation, in the terms of government, typical standard statutory requirements. There are so many environmental laws where we can move into, specialize in, find out how is the measurement done, because a lot of companies would now go into getting themselves assessed. So practicing company secretaries there's a whole lot of area of expertise which has opened up, where they can go and assess these firms. And definitely it calls for a lot of self-learning as well, to understand what these laws are, where do we stand, how is it that these reportings have to be computed, what is it that has to be seen. So a lot of assurance platforms can open for a company secretary where it comes to ESG with the requirements of BRSR, with the requirements of BRSR core. Definitely huge, huge, huge potential.
Yes, madam. Our next question is, what are the views on trade-off between financial performance and ESG performance? Should I repeat again?
Trade-off? No, I don't think there's a trade-off. It has to go hand in hand. And that is a realization that has come. You talk to anybody, you go out to the stakeholder community, everybody is talking about what is your ESG performance? How are you managing your environmental risks? How are
Yes.
you managing your business risks, your governance risk? What is it that you're doing to improve your governance? How is the committee deciding on factors of remuneration? How is the NRC involved in the senior management remuneration policies? You get into an AGM, people question on what are the payments that are being made to the professionals. So it's not a trade-off between financial and non-financial parameters. It is something which goes hand in hand. It is something that, well, it is, as I said, it's not just the top line or the bottom line which is now driving business. It is also the ESG performance which is driving business. It will get you low cost of capital. It will get you that reputational, visibility. It will definitely put you in a high pedestal compared to those who are not doing it.
The next question, madam. Value chain assessment is mandatory. If yes, what will be the process to follow the same?
I think I've answered it. It's not mandatory as of now. Definitely from 2025-26, it's going to be mandatory for the top 150 companies. And whereas where it is the process, a lot of ambiguity.
No.
At least where I'm concerned.
The next question is, what is the difference between BRSR and BRSR code?
BRSR and BRSR core. So
Yes.
BRSR, I have said, it's based on the 9 NGRBC principles. These have the essential indicators, the other leadership indicators which have to be given. BRSR core, on the basis of the 9 attributes that we discussed, there are 50 odd more KPIs which have been added, where we have to provide so they have also given as to how do you compute that. They've given a complete annexure with it, that this is to be computed in this manner. So, and if there is any deviation specific to your industry, that has to be highlighted. So maybe for a service industry, for a power sector, it will be completely different on the way they measure energy output. It will be different where it comes to measuring energy output in case of a service sector. So there'll be difference in the way that we disclose it, but it has been provided. The data, the parameters, everything has been provided, and we have to compute in that manner. So companies are actually gearing up and definitely taking the help of professionals to get it done. So it is not, if you ask me as a CS, do you understand those parameters? Sorry, I don't. It's completely technical. So when it comes to probably an engineering maintenance guy would be able to more understand what are the energy requirements. An EHS guy would be much more be able to understand what are the waste requirements. So probably a practicing company secretary can also understand once you undergo those trainings and understand what the laws are and how do you compute these requirements.
The next question, how can company secretary effectively collaborate with the executive team to integrate ESG considerations into the company's long-term strategy?
Company secretary has to collaborate, definitely has to collaborate with the management team, guide them, make them understand. This is one guy who sits through all meetings. Any meeting in the company, you will find the company secretary sitting there. Accessible to all information, all the important information, all the strategies, everything is accessible to the company secretary. It is for us to be alert, to know exactly when to say what and how to guide people and take them through this journey. So it's a complete journey of how do you understand what is the requirement, how do you strategize that what is to be done, evaluate what are your strengths, what are your weaknesses, how is it to be done.
Yes.
Then go down to actually doing it and then reporting it, measuring and reporting it. So it is an entire cycle, it is an entire journey, and it is our role there to very clearly play and bring it out to the notice of the management and the board and tell them that this is exactly how it is to be done.
But madam, ESG is thoroughly a non-financial area, and ESG is a thoroughly non-financial area. How can the same have financial implications, and what level of seriousness is expected from corporations to mitigate the same?
Can you just repeat the first line that you said?
Yeah, ESG is a thoroughly non-financial area.
Yeah.
How can the same have financial implications, and what level of seriousness is expected from corporates?
I'll give you a simple example. ESG, governance. Governance comes compliance. You're not compliant now, definitely it will come with very high implications, financial implications in the future. You comply with it, you ensure that you are doing it in the right manner. You don't have to pull down an industry. You have the license to operate. Tomorrow, if you are not doing things ethically, tomorrow, if you're not doing things in the interest of the environment, in the interest of the society, you may probably have to shut down a unit. That is definitely which is something going to cost you a capital. Cost you in terms of your financial aspects. So it is very well clearly linked to what we are financially doing. Companies are being penalized. We have to understand that. Not very evidently now, but which will definitely come up, because we are now having a regime where we are being mandatorily required to be giving certain information. So if you do not do it in the right manner and you keep on disclosing that we are not doing it, no one would want to invest in you. You would probably be wanting, there'll be a time when you would want to shut your unit, because no one would be wanting to be associated with you. No one would be wanting to be in your value chain.
Yes, madam. The next question is how to verify accuracy and reliability of emissions calculated and reported by us.
As I said, it needs validation,
Very
because
good.
otherwise we just we are the voices of our own deeds. We say that we have done it.
Value chain assessment is mandatory. If yes, what will be the process to follow the same?
Same question actually. Value chain assessment. This is actually going to be a big topic in the near future.
Madam, so you covered more or less all the questions from across the country, and number of participants, we are touching 12,300 now. So it's a great proud for me, for ICSI, to have you and to have your words of wisdom for all our members, madam. Thank you very much.
It's my privilege.
Thanks for covering all the tiny points of ESG in a very practical way, madam. Thank you very much. Thank you.
Thank you.
Thank you, ICSI team. Thank you.
Thank you.